If you've watched any video about Roth conversions in the last several years, you were probably told the same thing. You were told there's a deadline, you were told that tax rates were scheduled to snap back up, that the low brackets were temporary, and that you had to convert before the window slammed shut. That argument is gone. The rates that were supposed to expire were made permanent. There is no cliff coming, which means a very large amount of the Roth conversion content sitting on this platform right now is built on a reason that no longer exists. So here's the question this video answers. If the deadline was the whole argument and the deadline is gone, does the strategy still matter at all? It does, but not for the reason you were told. It matters because of the shape your income takes in retirement. For most people who retire in their early or mid-60s, taxable income falls off a cliff the year they stop working, sits unusually low for several years, and then climbs back up permanently when required distributions and Social Security both switch on. That valley is the entire story. It's usually somewhere between 4 and 11 years long. It never comes back. And what you do inside it can change your tax bill for the rest of your life, your surviving spouse's tax bill after you're gone, and what your kids actually keep from your retirement account. In this video, I'm going to walk through exactly how that window forms, the 4 mechanics that make it valuable, the 5 ways people damage themselves trying to use it, and who it flatly doesn't work for. I'm going to show you the arithmetic on screen so you can run it on your own numbers. I'm not going to tell you what to do. I'm going to show you how the machinery works, because this is one of those decisions where the right answer genuinely depends on numbers that only you have. Let's start with what a conversion actually is, because it gets described badly almost everywhere. A Roth conversion is you moving money from a pre-tax retirement account into a Roth account and paying the income tax on it in the year you move it. That's the whole thing. It is not a contribution, it is not an investment. You're not buying anything and you're not putting new money in. You are taking dollars you already own and changing which tax rules apply to them going forward. Here's what's actually happening under the hood. Every dollar in a traditional IRA or a traditional 401k went in without being taxed. You got a deduction the year you contributed. The government's position has always been that it will collect eventually, when the money comes out. So a traditional IRA balance is not entirely yours. Some percentage of it belongs to the IRS, and the exact percentage hasn't been determined yet because it depends on what tax rate applies when the money finally leaves. That's the uncomfortable part. You have an account balance on a statement, and you do not know what fraction of it you actually get to spend. A $300,000 traditional IRA might be worth $240,000 to you, or $210,000, or less, depending on what bracket you're in when you pull from it. A Roth account has no such ambiguity. The tax has been paid. The balance is the balance. Growth comes out untaxed if you follow the rules, and this is the part that matters most for what we're discussing. A Roth IRA has no required distributions during your lifetime. Nobody makes you take money out, ever. So a conversion is you volunteering to settle up early. You're choosing to pay tax now instead of later. And immediately you can see the only question that matters. Is your tax rate now lower than your tax rate will be later? If the answer is yes, converting moves money from a high tax future into a low tax present, and you keep the difference. If the answer is no, you just paid extra tax for nothing. There's no cleverness here and no loophole. It's a rate comparison. That's it. Which brings us to why the years right after you retire are unusual. Think about what happens to your taxable income across 3 phases of life. Phase 1, you're working. Your salary is the biggest number on your return. Whatever bracket you're in, that's the bracket. Conversions during these years are usually expensive because you'd be stacking converted dollars on top of a full year of wages. Phase 2, you've retired but the automatic income streams haven't started yet. Maybe you're living off a cash reserve or a taxable brokerage account, or selling investments where only the gain is taxed and often at favorable rates. Maybe you've deliberately delayed Social Security. Your taxable income in these years can be dramatically lower than it's ever been as an adult, sometimes low enough that you're barely filling up the standard deduction. Phase 3, everything switches on. Social Security is running, required minimum distributions have started, and those are not optional. The IRS makes you withdraw a percentage of your pre-tax balance every year, whether you need the money or not, whether you want the taxable income or not. If you have a pension, that's running too. Suddenly you have a stack of income you don't control. Tall, then short, then tall again. That shape is the single most important thing to understand in retirement tax planning, and almost nobody has it explained to them before they retire. For most people, that middle section is the lowest tax period of their entire adult life. It starts when the paychecks stop and it ends when required distributions begin, which, depending on when you were born, is at 73 or at 75. Confirm which applies to you because that changed recently, and a lot of sources are still wrong about it. If you retire at 63 and your required distributions start at 73, that's roughly 10 years of unusually low taxable income. If you retire at 68, it might be 5. If you work until 72, you may have almost no window at all. And here's the thing about the window that makes it different from most financial planning. It's not renewable. Every year you spend in that low-income valley without doing anything is a year of low bracket space that expires unused. You don't get to carry it forward. Once required distributions start and Social Security is running, your baseline income is permanently higher, and you never get access to those cheap brackets again. That's the asset, not a deadline imposed by Congress, a window created by your own income pattern. Now let's talk about why that window is worth using, because lower bracket now is only the first of 4 reasons, and honestly, it's the weakest one. This is the mechanic everyone knows, so I'll be quick, but I want to fix a misunderstanding that comes up constantly. Tax brackets are marginal. That means when you convert, you don't pay one rate on the whole conversion. The converted amount stacks on top of your existing income and fills brackets from the bottom up. So if your other income leaves you partway up one bracket and you convert an amount that carries you to the top of that same bracket, every converted dollar is taxed at that rate. Convert more and you spill into the next band, and only the spillover pays the higher rate. This is why the phrase you'll hear is filling up a bracket. The idea is to convert precisely enough to reach the top edge of whatever bracket you've decided you're willing to pay, and then stop. The comparison that decides whether this is worth doing is the rate you'd pay converting today versus the rate those same dollars would face when required distributions force them out later. If you're in a low band during the gap years and your projected rate once everything switches on is 2 bands higher, the arbitrage is real and it's just arithmetic. But, and this is why I called it the weakest reason, for a lot of people the gap is only one bracket, or the rates come out roughly even. When that happens, bracket arbitrage alone doesn't justify the tax bill and the loss of the money you paid it with. The 3 reasons that follow are the ones that actually move the decision for most households, and they're the ones almost never covered properly. Quick pause, and then we get into the part that matters. If you're finding this useful, subscribing genuinely helps. This channel is 1 video a week, every one of them a single retirement decision worked through with the actual arithmetic on screen. No hype, no product, no one weird trick. Just the mechanics sourced so you can run your own numbers or walk into a meeting with your advisor already knowing what questions to ask. The 2 videos most people watch next are the Social Security claiming age breakdown and the one on how much of your Social Security actually gets taxed. Both of which connect directly to what we're about to cover, because Social Security timing and conversion timing are the same decision wearing 2 hats. Links in the description. Alright, reason 2, and this is the one that changes minds. Required minimum distributions are the part people underestimate because they think of them as just withdrawing their own money. Mechanically, that's true. Tactically, there's something else. They're a mandatory, escalating, non-negotiable stream of taxable income that lands on your return, whether or not you have any use for it. Here's the mechanic. Each year after your starting age, you divide your prior year-end pre-tax balance by a factor from an IRS life expectancy table. That's your required withdrawal. As you age, the divisor gets smaller, so the required percentage gets larger. It starts modest and grows every single year. Now overlay the problem. If your account keeps growing, you have a rising percentage applied to a rising balance. The required dollar amount can climb faster than you expect, and it never comes down. And this is where the connection to conversions becomes clear. Required distributions are calculated on your pre-tax balance. Roth accounts aren't in that calculation at all. So every dollar you convert during the gap years is a dollar permanently removed from every future RMD calculation, along with all the growth that dollar would have generated inside the pre-tax account. That's the leverage. You're not just moving 1 year's tax bill around. You're reducing a compounding stream of forced taxable income that would otherwise show up on 20 or 25 consecutive tax returns. And notice this reason doesn't need tax rates to change at all. Even if your bracket is identical before and after, there's value in controlling when income appears rather than having a table dictated. Control has worth on its own because forced income is what pushes you into the problems in the second half of this video. The Medicare surcharge, the Social Security taxation formula, all of it. Reason 3 is the one that people find upsetting when they first learn it, and it's the strongest argument on this list for married couples. If you're married, you file jointly, and the joint brackets are roughly twice as wide as the single brackets. Same for the standard deduction. The tax system assumes two people. When one spouse dies, that changes. After a transition period, the survivor files as a single taxpayer. Same brackets you'd use if you'd never been married. Now here's what makes this a tax problem, rather than only a personal one. The household's income usually doesn't fall by half. Think about what the survivor still has: the entire retirement account balance. It transferred to them. Required distributions on all of it. A pension, often continuing at a reduced but substantial level. And on Social Security, the survivor generally keeps the larger of the two benefits rather than both. So household Social Security drops but doesn't disappear. So income falls somewhat and the brackets fall by half. The result is that a surviving spouse frequently pays tax at a higher rate on less income than the couple did together. The same withdrawal that was comfortable at joint rates gets taxed harder as a single filer, and it can push them over the Medicare surcharge thresholds, which are also roughly half as generous for single filers. This is a known feature of how the code interacts with mortality, and it lands on whichever spouse lives longer, statistically more often the wife, and often for a decade or more. Conversions done while both spouses are alive and filing jointly are done at the wider brackets. Every dollar converted is a dollar the survivor never has to withdraw at compressed single rates. You're using the joint brackets while you have them, on money that would otherwise be taxed under the narrow ones. I'd argue that for most married couples with meaningful pre-tax balances, this is the single strongest argument for using the gap years, and it's the one that gets the least airtime, probably because it requires talking about one spouse dying, which nobody enjoys. Reason 4 is about your kids. The rules for inherited retirement accounts changed significantly a few years ago, and this one catches families off guard because the old rules were so much friendlier. It used to be that a non-spouse beneficiary, an adult child typically, could stretch withdrawals from an inherited IRA across their own life expectancy. Small withdrawals, decades long, modest tax impact each year. For most non-spouse beneficiaries now, the account has to be emptied within 10 years. Confirm the specifics and the exceptions on irs.gov because there are carve-outs and the details are genuinely intricate. Compress the same balance into 10 years and the tax consequence changes shape entirely. And consider when that 10-year window usually lands. A child inheriting in their 40s or 50s is often in their highest earning decade, so a large inherited pre-tax account gets emptied on top of peak career income, potentially at the highest rates that person will ever face. An inherited Roth is different. There's still generally a 10-year emptying requirement, so confirm the current rule, but the withdrawals aren't taxable income to them. The account can sit and grow for most of the decade and come out without a tax bill attached. So the comparison is really this: would you rather pay the tax at your gap year rate or have your child pay it at their peak earning rate? For families where the pre-tax account is likely to outlive the parents, that question can be worth more than everything else in this video combined. Alright, that's the case for now the far more important half, because I've watched people damage themselves badly with this strategy, and every one of these is avoidable. If you convert and then pay the resulting tax by pulling extra from the retirement account, you've undercut the whole point. Less money lands in the Roth, and if you're under 59 and a half, the portion used for taxes can carry a penalty on top. The version that works has you paying the tax from outside money: a savings account, a taxable brokerage account, cash on hand. That way the full converted amount arrives in the Roth, and every future dollar of growth is on the larger balance. If you don't have accessible outside money to cover the tax, that's a real constraint on how much you can sensibly convert, and it's worth being honest with yourself about it before you start. Medicare, Part B and Part D premiums are income adjusted. Above certain thresholds you pay a surcharge, and it's tiered, cross a line by a small amount, and you move to the next tier for the whole year. The part that ambushes people is the look back. Your premium in a given year is based on your tax return from 2 years earlier, so a large conversion at 64 or 65 can raise your Medicare premiums at 66 or 67, long after you've forgotten about it, and it hits both spouses. Two things follow. Conversions done well before Medicare enrollment don't touch this at all, which is an argument for starting early in the window. And once you're in the look-back range, the tier thresholds become hard ceilings you plan against, not surprises you discover. How much of your Social Security is taxable depends on a separate calculation using what's called provisional income, roughly your other income plus half your Social Security, and it includes some items that aren't otherwise taxable. Push that figure across certain thresholds, and a larger share of your benefit becomes taxable. The awkward result is that a conversion can generate additional tax not only on the converted amount but on Social Security that wasn't being taxed before. Your effective rate on that conversion ends up higher than the bracket suggests. This is the strongest mechanical argument for doing conversions in years before Social Security starts. If there's no benefit being received, there's nothing for the conversion to drag into taxation. It's also why claiming timing and conversion timing have to be decided together rather than separately. I've linked that video below. If you retire before Medicare eligibility, you may be buying coverage through the marketplace with a premium tax credit based on your income. Conversion income counts toward that calculation. A conversion that looks cheap on the bracket ladder can cost you thousands in lost premium credits. And there are income points where crossing a line means repaying credits you already received. For someone bridging from 62 to 65 on marketplace coverage, this can make conversions in those specific years genuinely uneconomic even when everything else argues for them. There used to be a mechanism to reverse a conversion if the market dropped or you converted too much. That was eliminated. A conversion is final. If you convert in January and the market falls 30% by December, you owe tax on the January value. You cannot unwind it. That's a strong argument for converting in increments rather than one large transaction, and for doing it late in the year when you have a clear picture of your actual income rather than a projection. One more mechanical note. Converted amounts have their own 5-year clock before the converted principal can be withdrawn penalty-free if you're under 59 and a half, and each conversion starts its own clock. If you're in your 60s, this rarely binds, but if you're converting in your 50s, look it up properly. I want to be clear that this is not a strategy that helps everyone, because the internet tends to present it as universally good, and it isn't. If your income in retirement will be lower than it is now, converting at today's rate means paying more than you'd have paid later. That's a straightforward loss. If your pre-tax balance is modest enough that required distributions will never push you out of a low bracket, there may be nothing to solve. The strategy addresses a problem you don't have. If you have no outside money to pay the tax, the mechanics work against you for the reasons in point 1. If you're leaving your retirement account to charity, converting is often counterproductive. A qualified charitable organization doesn't pay income tax on a pre-tax inheritance, so the embedded tax liability you'd be paying off simply evaporates on its own. Paying it early destroys value. If your health situation means one spouse is unlikely to survive the other by long, the surviving spouse argument weakens considerably. And if you're still working a full salary year, you're usually converting into your highest brackets. Waiting for the gap costs you nothing. The honest summary is that this is a rate comparison with several complications layered on top, and the complications are what make it a real analysis rather than a rule of thumb. Anyone who tells you conversions are always right or always wrong is not doing the arithmetic. If I compress the mechanics into a way of thinking about the timeline, it looks like this. The years between your last paycheck and Medicare enrollment are the cleanest because no Medicare surcharge lookback and no Social Security taxation interaction. Subject to the marketplace coverage issue if that applies to you. The years between Medicare enrollment and the start of Social Security are still useful, but now the surcharge tiers act as ceilings you plan against. The years after Social Security starts, but before required distributions are the tightest, because both the bracket ladder and the provisional income formula are in play at once. Still often worthwhile, but the effective rate needs calculating rather than estimating, and once required distributions begin, the window is closed in the sense that mattered. Conversions are still possible, but you have to satisfy the required distribution first, and it fills your low brackets before you get to use them. The practical takeaway: this is a multi-year sequence, size annually against your actual return, not a single transaction. People who use the window well convert a moderate amount every year for 8 or 10 years. People who use it badly convert one enormous amount and trip 3 of the 5 problems at once. On the mechanics of actually doing it, 3 things are worth knowing, because the execution details are where the arithmetic either survives or doesn't. First, timing within the year. Most of the input you need, your actual dividends, your actual capital gains, whether you took an unexpected withdrawal, isn't knowable until late in the year. Converting in January means sizing the conversion off a projection. Converting in November or December means sizing it off something close to a final number, which matters a great deal when you're trying to stop precisely at a bracket edge or stay under a surcharge tier. The trade-off is that you give up a year of tax-free growth inside the Roth, so some people split the difference and convert in stages. Second, the ceiling you're aiming at usually isn't the bracket. Once you've layered in the surcharge tiers and the Social Security formula, the binding constraint is often something other than the bracket line, and it's frequently lower than you'd expect. The number you convert to should be whichever ceiling comes first, not the bracket top by default. Third, this is one of the few areas where a single hour with a competent tax preparer before December tends to pay for itself many times over. Not because the concept is hard, you've just watched the whole concept, but because the interaction between 4 or 5 simultaneous thresholds on your specific return is tedious, and tedious is exactly what software and a professional are for. So, to bring it back to where we started, the deadline argument that most Roth conversion content was built on is genuinely gone. But the window was never really about the deadline. It's about the shape of your own income across retirement. A valley that opens when you stop working and closes when the required distributions start, lasting somewhere between 4 and 11 years, never returning. What makes it worth using isn't only the bracket difference. It's shrinking a compounding stream of forced income for the rest of your life, using joint brackets while both spouses are alive to spare the survivor the compressed single ones, and deciding whether the tax on that account gets paid at your gap year rate or your children's peak earning rate. And what makes it dangerous is that 4 of the 5 failure modes are invisible in the year you convert. The Medicare surcharge shows up 2 years later. The Social Security drag hides inside a formula most people never see, which is exactly why this is a run-the-numbers decision rather than a rule-of-thumb one. If this was worth your time, subscribe. One retirement decision per week, worked through properly with the sources on screen. And I'd genuinely like to know in the comments where you are in that timeline. Still working, in the gap, or already taking required distributions. It tells me which decisions to cover next, and I do read them. The 2 to watch next are the Social Security claiming breakdown, because as I said, that decision and this one are the same decision, and the one on how much of your Social Security gets taxed, which is the formula sitting underneath risk number 3. Both are linked below. I'm not a tax professional and nothing here is advice about your situation. What I've tried to give you is the machinery, so that when you sit down with your own numbers or someone else's spreadsheet, you know what's actually being calculated. Thanks for watching.